episode 130 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risk and seize opportunities. Learn more at futuresfundamentals.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudelli sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudelli.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we begin, I want to thank our sponsors, CME Group and Trading Technologies. So without further ado, let's dial into those top moments of the show for the month of May.
So let's start off with that, Morad. What are the key elements that make a successful trader?
So the first thing I want to cover, and my background is training prop traders. The first thing I want to cover is traders have to make a commitment to trading. You have to trade as a business. I see a lot of people get into trading as almost a hobby. The second part is to make sure that you're well capitalized. Coming in with a tiny bit of money, the leverage in futures it improves your results, but it also creates a lot of risk. And it's really important to make sure that you're capitalized enough that you can take advantage of the moves and have reasonable stops and targets when you trade. The third thing that's really important is a clear plan. And this is where most of the focus goes. Traders are chasing the next great indicator, the next winning plan or whatever. And it's really important to have your own personalized, clear plan for how you want to trade. The other two parts are self-awareness. Not many people talk about this. You need to understand yourself as a trader. You need to make sure you understand your triggers, not losing your mind when you're in a bad trade, not changing your plan when you're in a bad trade. We all tend to get smarter in the middle of a trade, and it's not advisable. The last thing is grit. So when I look at a trader that I'm backing for a prop operation, for proprietary trading, I want somebody with grit. I want to see someone who has failed and stood up again, failed and stood up again, and grit requires discipline, right? So there's this factor of discipline. So a lot of that is psychology, and those are I think, 5 key things that need to come together to push you through the learning phase, the hard part of learning how to trade.
Now, we talked about risk management, you and I as well. We were talking about that coming into today's recording. And as I said to you, and I'll say it to our audience again, we've had a lot of discussions with pretty much every trader, hedge fund manager, CTA, et cetera, on this show about risk management, because to me, really, that's what trading is. That's why I love having this discussion. But you have some specific thoughts on how traders should be approaching risk management. You said they shouldn't just be looking at numbers, but they should have a broader view. Please explain that.
Yeah, so I mean, when you start trading, everyone tells you to let your profits run and cut your losses quickly, right? And that's pretty much just based on the market prices, right? On the data that's coming in from the exchange. But we look at it a little bit different. We think there's more to risk management than just looking at pure numbers. You need to see what's happening in the broader market. So a simple example is if you're trading crude oil, for instance, and OPEC is about to sign an agreement with all the member countries to restrict production. But while you're trading, you see the price of crude oil going down, and you're trying to limit your loss because the price is going down. But in fact, if they actually come up with an agreement and the agreement holds, then the price of crude oil is most likely going to rise. So you need to incorporate data and information coming from multiple sources rather than just strictly looking at the market. It's easier said than done. I mean, I'm sure while you were trading, everyone said, well, cut your losses early and let your profits rise. It's easier said than done, but it should be a good tool set in a trader's I guess, bag of tools when trading, because just focusing on market data is not going to, well, you're not going to last very long trading that way.
Yeah, I want to take that a step further and talk about another blog post that you had written talking about the Minsky hypothesis playing out in the markets has been fascinating. And you said that risk-taking has slowly grown to the point where selling volatility in S&P puts has become commonplace. And I love this post about the Uber driver. It was great because I can actually relate it to what's happening in my life. I mean, I play a lot of golf. I'm out there talking with a lot of people all the time. And all of a sudden you're hearing stories about easy money being made. You know, people have been riding the rally all feeling really great. Now you hear people talking about selling puts against the S&P and people talking about shorting the VIX and people consistently making money on that. And we all know as traders, Jesse, it's never that easy. And in your post about the Uber driver mentioning that to you, it feels to me like the exact opposite of where we were at the end of 2008, beginning of 2009, when nobody wanted to be long. Now everybody wants to be long, and not only do they want to be long, they want to be short VIX, they want to be short S&P puts, and they want to be leveraged long. And as traders, you know, we look at this and we're in this exact 180 position, and it doesn't mean that the market's going to go down, but it sure feels like it's getting a little crowded up here, so we always like to keep note of it. And all of this conversation actually started when you tweeted about a Zero Hedge article, which got a big reaction on Twitter, and then you wrote the post, and then, you know, started talking more about the Minsky hypothesis. And I admit, I did not even know what the Minsky hypothesis was. I had to Google it before we recorded today. So if you could begin by telling us what the Minsky hypothesis is, and secondly, give us your thoughts about hearing people selling VIX and volatility and buying S&P puts becoming commonplace.
Yeah, no, it's Hyman Minsky was an economist who was he was really an obscure guy. Nobody really knew much about him until the financial crisis, and they went back and read his writings, you know, from 30 plus years ago. And he basically had a theory about the business cycle is really driven by the credit cycle. And early on in the cycle, lenders will make loans that are backed by collateral, right? They want to make sure their money's really protected. So they make very conservative types of loans. And then as the cycle progresses, they're willing to take a little more risk and then lend just based on interest coverage. So as long as a company makes enough money to cover the interest, they'll make the loan. Towards the end of the cycle, you start seeing loans that are made that are much, much more speculative, where a company is borrowing money and the lender knows they're going to have to borrow more money in the future in order to pay back this original loan. So, I think that, the three stages of the credit cycle, and then you reach a point which is, the Minsky moment, where you realize everybody's over-leveraged and, money can't be paid back and you get a crash. And I think the same thing plays out in the markets for risk assets, stocks and things. And so, in the stock market, we see it as, okay, people tiptoe back into the stock market in 2010, 11, 12, and 13. You see them really start to embrace stocks and do so on margin. And so now we have massive borrowing to buy equities. Margin debt to GDP is at record highs. And then borrowing and buying on margin is not enough. And so you got to start selling volatility or selling, put options on the summer. So it's watching risk appetites go from very conservative to extremely risky strategies. And I don't think people realize how far we are along in this process. It's not just volatility selling. The speculator short position in VIX futures is massive. And then every one of the VIX ETFs, is essentially used as a tool to short VIX. And VXX, the most popular one, is 95% of the shares are sold short. But there's volatility targeting strategies. Risk parity is probably the most popular one of those, or famous one of those, but there's also just pure volatility targeting that insurance companies use. And so they're all, matching their exposure to the stock market, a lot of times leveraged exposure based on the level of the VIX. So you get short sellers, suppress the VIX by, selling it short. That pulls in all this volatility targeting money also on top of it, which a lot of it is leveraged. And I've seen estimates that that's up to $3 trillion in various volatility targeting strategies. And so I just think we've gone back. If you think back to what it felt like in 2009, at the bottom, nobody wanted to own stocks. People who were starting to tiptoe back in 2010-11 in very conservative ways, and now we've come full spectrum. We're on we're in that stage 3 Minskyan evolution in this market process to where now people are taking incredible amounts of highly leveraged risk.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. So we've talked about some benefits. We've talked about some reasons why you believe investors should have futures in their portfolio. But what are the factors that are driving people to want to get into managed futures?
Look, as we just talked about, that diversification benefit that clients can experience in a portfolio is really powerful. The mathematics are pretty powerful when you add an uncorrelated return stream into a portfolio. Of course, that uncorrelated return stream has to be positive. The strategy has to make money over time. And as advisors get educated about that and they consider the risks that they have in their more traditional portfolios, that's driving the demand. And if you look at those risks, there's quite a few, especially in today's environment. I think the big driver right now is in two facets, really. Central bank policy divergence. That's a big sentence, but really we're really talking about the fact that the U.S. Federal Reserve is increasing interest rates. The Bank of Japan and the European Central Bank continue to be on hold. In our future, we've got the Fed not only increasing interest rates but figuring out how to normalize their balance sheet. And that development of central bank policy divergence is really in stark contrast, Anthony, to the post-crisis environment where all of the central banks really following a zero interest rate policy that had created an environment where there was little differentiation between the three big global economies in terms of interest rate movement and currency movement, and therefore sort of little opportunity for really significant trends to develop. And trends are, of course, the lifeblood of managed futures success. So point number one, central bank policy divergence. And point number two, and we're starting to see this, is an ongoing shift towards an environment potentially that we could describe as fiscal policy coming back to play. And, the fact that we've seen this rise in populism that started with Brexit and then the election here at home of President Trump, and that shift towards the possibility of more fiscal policy dominance here at home seen through tax reform, infrastructure spend, we actually have an opportunity for, global economic growth, but also global economic differentiation between these key economies, which is, again, as I said, the lifeblood of trends. The risks that I refer to are numerous, of course. We've got, as the markets have anticipated, some of those positive developments here in the U.S. Of course, we've got highly valued stock market that potentially could correct. And I don't think the geopolitical risk out there is being fully priced. It seems like we've got a really low volatility environment right now as we speak, and there's lots of reasons why that volatility could increase, not least of which you could focus on North Korea, China. I mean, I know the European environment seems a little more settled now post the French election result, but there seems like there's plenty of opportunity for instability, and I think that as investors look at their portfolios and consider, what do I have in my portfolio that could provide me an uncorrelated return in an environment that's different than the one we're experiencing today, managed futures is becoming increasingly an option for that. The the volatility environment, ideally we would like to see it change. Managed futures does better, Anthony, when volatility is expanding as opposed to contracting. And, as I said earlier, the central banks have done a tremendous job, frankly, in the post-crisis environment of averting another crisis. There's been crisis containment. They've really done a good job of that. And traditional investments, such as, a stock market allocation, have done tremendously well. But as volatility potentially increases and expands, that's positive for managed futures. And as I said, there's a lot of potential for risk on the horizon that can drive that volatility. Finally, I'll say one other point, and this is a more nuanced point, but I think people will get it. When you invest in a managed futures investment, be it in a managed account or in a fund, the manager uses typically only 10 or 20% to actually drive the strategy because of margin use. It typically only takes 10 or 20% margin to equity use on any given day to drive a managed futures strategy, which means that 80 or 90% of a fund's assets are sitting around typically in T-bills or some other collateral. Well, historically, of course, T-bills have earned, anywhere but 3% on average over several decades. Except in the post-crisis environment where it's been essentially zero. So a rising rate environment puts that collateral earnings back into the managed futures strategy, and I think that's going to be positive for returns as we go forward.
Now, I want to pick your brain a little bit there, Lisa. Now, you follow this data as close as anyone. And something that you mentioned to me, which I thought was very, very interesting, you said that you have been seeing some strange builds in both Russia and Iraq oil storage. Can you talk to us about what you've been seeing?
Yes, so obviously because me and Sam sit on all this data, we have been looking into and noticed a few things in regards to the Iraq-Russian storage, also Iran as well previously. What we've done is, because obviously we sit on all this data, we've analysed a lot of it. We've kept a close eye on the government statistics again, which I've mentioned earlier, and we have strong reason to believe that both Iraq and Russia have inflated the production figures. Now, we found that because if we deflate the figures that we've got on our government statistics by removing the excess or their so-called storage from the production figures that they've reported, it gives you what you would assume would be more reasonable or realistic figures where you'd think their exports would be at, or where you'd think their production figures would be at. So the biggest clues that we came to this conclusion was that both countries, both Iraq and Russia, showed that they've got excessive stock increases when it doesn't really make sense, or it's not really logical either. Now, they've not really made any massive investments into the storage sites either to suggest that they could actually accommodate all this extra building storage. So, for example, like Iraq last year, they added 76 million barrels to their so-called storage. Now, that works out around 207,000 barrels per day. Just like Russia last year added supposedly 102 million barrels, which again works out around 279,000 barrels per day. Russia revised their figures. Now, what they did previously have, it was 64.3 million barrels, but they actually revised it up, which came to the 102 million. So that meant that it showed an even larger build in their crude oil inventories, which again, it does not make sense. Like last year, Russia, especially in summer, was saying that they needed to boost the investments in order to up the production. However, at the beginning of October, just a few days after the Algiers OPEC cut announcement, they published that they'd increased the figures miraculously by 400,000 barrels per day. Now, that just doesn't make sense. Now, that was from 10.7 million barrels per day. Managed to boost them right up to 11.1 million. So by the end of October, they'd reached peak production of about 11.23, knowing full well that this could give them the upper hand in the OPEC deal, obviously increasing their baseline. So technically, on paper, they are cutting, but they're not really. So that's what we've managed to get from them. So recently as well, a few days ago, Russia released April figures and stats showing that they had 10.995 million barrels per day, which for the first time is actually under that 11 million barrels per day since the Algiers meeting last year. But if you look a bit closer and look at previous years as well, you'll see that April is historically the peak in exports due to the warm weather openings up some of like the passageways and things for the tankers, like Siberia and things like that. So the exports jumped up to 7.3% in the recent release figures, up to 5.54 million barrels per day. Now, that's ridiculously higher compared to the same time last year. Now, that also continues to show a stock exchange as well. It's now at 26 million barrels. So that's what we've got for Russia. Now, going back to Iraq. Now, with the 76 million barrels that they had, during quarter 4 last year, Iraq's production averaged around 4.8 or 2 million barrels per day. And during Q1 of 2017, that was actually down by 208 million barrels per day. Now, that itself, the 208 million barrels per day, is a bit too much of a coincidence. It seems that last year, the 76 million barrels per day averaged out, 206 barrels that they added storage averaged out at 207. So 208, 207, bit of a coincidence. So basically, those seem to be cheating by increasing their figures. So I mean, Iraq as well during Q1. Again, it's a little suspicious that Iraq reported no stock change at all. Nothing, not even reported by Jodi Data or Soma, the Iraqi oil marketing company. So again, it just rings a lot of suspicion.
Talk to us a little bit about your methodology. What are you using to trade?
Primarily, I'm through and through trend following trader to the core. And I would say I'm a trend following person as well. You know, if you're a trend follower, it's very hard to keep it to just your trading. I believe if you whatever strategy you execute in the markets is pretty much how you're going to live your life as well. And I'm trend following, through and through. So initially I started trading, just about like a dozen different futures markets. Today I trade a little over 50, expanded my time frame. Back in the early days I didn't have as much capital in the management, so there's only so much you can do, only so much room you can give markets to move, and so I've made gradual evolutionary changes that I'm sure a lot of guys do. But yeah, I mean, a very long-term focus. Average holding period is about 10, 11 months. Like I said, 52 markets, and that trades everything from financials to commodities. Yeah, I mean, it's pretty much the basics of it.
What skills and characteristics do you think are required to survive and thrive in the prop industry?
It's funny. I think you've mentioned the first one, and the most imperative one is time. If you're not willing to give up 2 years of your career or your life to learn to trade, don't even bother. You're just you're wasting your time. So for me, 2 years minimum, you need to see it out for 2 years to know whether or not you love it enough to stick it out, to know whether or not, this is the kind of job you want to do, in the future. So first is time. Second is bankroll. It's no secret, it's no surprise. There's a very high correlation between, traders who come from money and traders who succeed. So if you do come from a bankroll, or you have someone that can take that financial pressure off you, or you can live with mom and dad whilst learning to trade, do it. Take the pressure off yourself. Don't be ashamed. You make the sacrifice today for what can only be considered as the most incredible freedoms in the future. Then the third, and this is probably something that I think is absolutely crucial to the success. And again, it's not necessarily a skill, but it's a strong environment. You know, I've always been lucky to have been in an environment where I had guys that were not just, you know, fantastically good traders, but they all had different skill sets. You know, some were scalpers, some were swing traders, some were, you know, fundamentally strong. Some, you know, you were amazing breakout traders. So I got to see all different variations of trading within one environment. Now, why that's fantastic is because you have this constant feedback loop. You know, imagine a comment comes out now and I'm particularly weak at it. I don't have to sit and think about it, you know, and figure out how I could become better. I can simply just go to the guy who's good at it, and, you know, he can kind of guide me through that. So, you know, being in a strong environment where there's experience helps so much. Then something again that's, you know, I think you need a bit of luck. I think anyone that says, you know, trading is gambling, to an extent it is. You know, everything is a 50-50. The market can only go up or down, and you need that little bit of luck. And I can tell you categorically, I think I've been lucky about 5-6 times in my career where some really crazy things could have gone wrong, you know, where you know, through maybe a bit of an error from my side, leaving an order without a stop, I got filled, and the next thing I was handsomely on side. You know, I mean, these things have happened to me. You know, I've clicked and markets have done crazy things before, you know, and I've been lucky. So I think luck is crucial as well. And then probably the most important characteristic. I know a lot of people talk patience and discipline and, you know, all these sorts of things. And yes, those are important, but I think one of the most important is the ability to keep things simple. You know, I think one of the biggest mistakes traders make, including myself, is we complicate things. We make up all these wonderful stories in our head as to why the market could go up, could go down, why it's doing this and that. And in essence, you know, the market has a binary outcome. And, you know, it's one of the things I firmly believe. The market can only go up and down. You know, so by that very nature, if you're able to simplify, you know, the process of trading, I think you'll be, you know, 100 steps ahead of everyone else who, you know, starts the game of trading.
You nailed that, Bran. Loved it. Now, I just want to say one thing to all those traders listening out there. That's not just for prop traders. That's for all traders. Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.